Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is the long-term debt requirements that were proposed for U.S. regional banks. My name is Matt Bisanz, and I'm a partner in Mayor Brown's Financial Services Regulatory Practice in our D.C. office. Joining me today are Mayor Brown partners Anna Pinedo and Christopher Chubb. Anna is a partner in our Corporate and Securities practice in our New York office, and Chris is a partner in our Banking and Finance practice in our Chicago office. With that said, let's begin. Late last month, the U.S. federal banking regulators issued a proposal for long-term debt requirements for certain mid-size and larger U.S. banking organizations. This proposal is important because it would require many of these organizations for the first time to issue significant amounts of eligible long-term debt. And while it would phase in over 3 years, regulators estimate that the affected banking organizations would need to issue at least $70 billion of new debt over that time. Now, who does this proposal apply to in actuality? Well, there are about 18 bank holding companies and savings and loan holding companies who are the prime targets of this proposal. They're again typically in the range of 100 billion to 700 billion in total assets. There's one U.S. intermediate holding company of a foreign banking organization that gets picked up because it is over $100 billion, but the FBO is not a foreign GSIB. And then there's 7 or 8 other U.S. banking organizations. Some of these may be standalone insured depository institutions or insured depository institutions that are owned by a holding company that is not a registered entity, or in some cases, they may be insured depository institutions that are owned by a foreign GSIB. While the foreign GSIBs had their intermediate holding companies in the U.S. subjected to long-term debt requirements several years ago, at that time, the requirements were applied only to holding companies, and so the subsidiary IDIs were not subject to it. While the subsidiaries of the U.S. GSIBs would remain not subject to the proposal or to long-term debt requirements, the IDI subsidiaries of the intermediate holding companies all would become subject to the requirements. And you may ask, why is this being done? And this is a proposal that has been long in the works for the U.S. banking regulators, at least now a year and a half. And it relates to the concern that the regulators would not be able to easily resolve a mid-sized banking organization. That after the 2008 financial crisis, there was a recognition that global systemically important banking organizations were really too big to fail. And so in order to resolve them in a way that did not impose an undue burden on U.S. taxpayers, that they should have strategies put in place that would allow the government to recapitalize and release them in a way that would allow their operations to be preserved. For the U.S. GSIBs, this was done through called the single point of entry strategy, in which the regulators envisioned only the top tier holding company entering insolvency proceedings, at which point the equity or the shareholders would be wiped out. Long-term debt would be converted to equity and either wiped out or maintained at a minimal level to recapitalize the GSIB. In recent years, regulators have expressed a concern that they may have difficulty resolving even a mid-sized bank, and this has been only heightened after the U.S. bank failures from earlier this year. And to provide greater optionality in resolving banks, the U.S. regulators proposed to impose this long-term debt requirement on mid-sized banking organizations. Additionally, regulators continue to recognize that these mid-sized banking organizations are not too big to fail in the sense of a GSIB, that there's not a foregone conclusion that the organization must be maintained. And so that is where the requirement for subsidiary IDIs to issue long-term debt comes from. The idea here is that a regulator may decide to sell off the holding company, to recap and release the holding company, to sell off a subsidiary IDI, to try to spin off a subsidiary IDI. And to maximize this optionality, the regulators would like to see long-term debt at both the holding company and the IDI levels. Now, there is a recognition that IDIs of a holding company typically operate in an integrated manner with that holding company. And so the long-term debt issued by the IDI subsidiaries would be, in most cases, issued internally to the holding company, and then the holding company would issue external long-term debt into the market. This is, again, a difference from the current rules where we only envision, or the regulators only have the holding companies issue externally to the market. There is no IDI-based requirement. Now, the effect of this will, for the mid-sized banks, will be that all of the holding companies and their banks will be affected, and the banks of intermediate holding companies will be affected. The regulators, though, continue to propose to not subject the IDI subsidiaries of US GSIBs to it, which creates a somewhat incongruous example of the US GSIBs having less regulation than even the intermediate holding companies of foreign GSIBs, but the regulators say that this feeds into the resolution planning obligations for the IHCs and for the US banking organizations. The long-term debt requirements will largely mirror the requirements for the US GSIBs. It will be a percentage of either their risk-weighted assets or total leverage. And Anna will talk more about the eligibility requirements for what that long-term debt must constitute. Additionally, there will be clean holding company requirements that Anna and I will talk about later in the program, which are not financial in nature, but do have a ramification for the structure of the banking organization. And finally, the proposal would not impose TLAC requirements on these banking organizations. That TLAC is a broader, all-encompassing concept of total loss absorbing capacity that goes beyond the mere issuance of eligible long-term debt. And the regulators say that that remains the provenance only of the US GSIBs, that they are not at this time imposing the TLAC absorbing capacity requirements on these US banking organizations. With that, to tell us a little bit more about what this long-term debt will look like, I turn it over to Anna.
Thanks, Matt. So as Matt said, these requirements are similar to the requirements that are currently applicable to the GSIB banks. So in order to qualify, external long-term debt has to satisfy a number of criteria. So external long-term debt has to be issued by the bank holding company, so by the top-level entity. It has to be unsecured. It has to be plain vanilla debt. So what does plain vanilla mean in this context? It means that it can't constitute a structured note. It can't be a security that has credit-sensitive features, so it can't have any particular incentive to redeem, for example. It can't have conversion to equity provisions or similar features. It can't have acceleration rights other than acceleration rights that would be exercisable on one or more dates that are specified in the instrument if the issuer enters into some type of resolution proceeding or the issuer fails to make a payment when due, and that payment failure continues for more than 30 days. So that's plain vanilla in that context. It also can't be a security that has a survivor's option or death put. So relatively straightforward debt securities. The securities have to have a remaining maturity of at least 1 year. So that means that long-term debt is going to lose 50% of its credit 2 years prior to maturity, and then the remaining 50% of its credit 1 year prior to maturity. Call options are permissible and would require regulatory approval to be exercised if redeeming the security is going to mean that the bank holding company is not going to meet its minimum long-term debt requirement. This feature of the long-term debt losing 50% credit and then the remaining 50% credit 1 year prior to maturity is exactly what the GSIBs currently face. The security has to be governed by U.S. law, and here's a new feature that is not currently applicable to external long-term debt for GSIBs. It has to have a minimum denomination of at least $400,000. So you might ask, why are bank regulators departing from the conditions that are currently applicable to eligible long-term debt for the GSIBs? Why this minimum denomination of $400,000 for the regional banks? Well, the rationale that's stated in the proposing release is that bank regulators don't want to see eligible long-term debt marketed and sold to retail investors. They want to see these securities sold to institutional investors, and they feel that this higher denomination is such that it will exclude the securities from being marketed and sold to retail. And the principal reason for that is that they don't want to be put in a position of being essentially in a kind of moral dilemma of essentially having to rescue a failing bank precisely because the securities of the banking institution are widely held among retail investors, and regulators would not want to see a situation where retail investors are going to stand to lose a potentially a fair sum of money. So we will see how commenters react during the comment period to the high minimum denomination. While it's currently the case that most bank senior debt instruments are sold largely to institutional investors, there are some securities that are sold to high net worth retail investors. So we'll see how that works out. Matt also mentioned a requirement for internal long-term debt. Internal long-term debt essentially has to meet all of the criteria that I talked about for external long-term debt, except that that minimum denomination requirement does not apply. And of course, that kind of stands to reason. It's an internal instrument. It's not being sold outside of the corporate family. So there's a phase-in period. The proposal provides for 3 years from the date on which the final rule is published in the Federal Register to eventually come into full compliance, and then there's a phase-in. The phase-in is structured so that 25% compliance is required within a year of effectiveness, and then 50% within 2 years, and then 100% by the end of the third year. And then if banks subsequently become subject to this requirement over time, they similarly get the benefit of the full 3-year phase-in period. Now, there may be a number of banks that will be subject to this new requirement that will have to issue additional long-term debt in order to meet these requirements. However, most outstanding external debt that's already been issued, including debt that was issued prior to publication of the notice, will be grandfathered. and it's going to be grandfathered even if it doesn't satisfy all of the proposed eligibility criteria. So, for example, even if it doesn't satisfy that minimum denomination criterion that I just mentioned. So, for the bank holding company requirement, for example, bank holding company debt and IDI debt issued to the market would be included. It's unclear whether existing internal debt would be grandfathered for the IDI's long-term debt requirement. So we shall see. There have been a number of different calculations and analyses that have been released by some of the rating agencies that show that based on current estimates, there are a number of regional banks that would have a shortfall in terms of eligible long-term debt, and in particular, that would have a shortfall in meeting the IDI long-term debt requirement. Now, Matt also mentioned another requirement that is part of the proposal and that is very similar to the rule that's currently applicable to GSIBs. So this proposal would prohibit all of the covered bank holding companies from having a certain category of liability. This is part of the clean holding company requirement that Matt referred to. So the types of liabilities that they would be prohibited from having at the holding company level are short-term debt. So this is debt that has an original maturity of less than 1 year. Qualified financial contracts with third parties. So QFCs would include certain securities, financing contracts, certain derivatives. Those would be prohibited at the bank holding company level. Guarantees that include cross-default type provisions, upstream guarantees, contracts or other agreements or arrangements that include offset rights. The proposal also would impose a limit on certain types of non-contingent liabilities. So this all makes sense if you go back to Matt's initial explanation for why regulators think that we need this, which is to make it easier to resolve a regional bank upon a stress scenario. If there's a failure of a regional bank, you want that bank holding company to be clean, quote unquote, and to be easily resolvable. And if you have these types of obligations, the types that I just went through, it makes it a little bit more complicated to address. So for some of the banks that are included that are captured by the proposal, dealing with the clean holding company requirement may not pose much of a challenge. However, there are quite a variety of institutions that are included or captured by this proposal. And for some of them, they may not have given a lot of thought to the types of arrangements or contracts that they have entered into at Topco. And so addressing this clean holding company requirement and moving certain arrangements, certain liabilities may take some doing and may take some planning. In particular, that's the case if you look at certain of the affected entities as a group, and certain of those entities include as the topmost company in the corporate group, a regulated entity, and now you need need to transfer some of these contracts or arrangements to another corporate entity within the family that may need to be a licensed entity, or you need to enter into service agreements or service contracts or make other provisions or arrangements. All of that may take some time and some careful planning. Matt, I don't know if you want to add any more color to the clean holding company requirement. I think it's not gotten as much attention as it deserves.
No, I don't have anything to add. I think you're spot on, but I do think it will pose a lot of operational difficulties, particularly for some of these mid-sized banking organizations that have complex operations or widespread activities at their top tier holding company, but don't have the same market presence to be able to negotiate with counterparties and insist on restructuring or transfers of third-party obligations into subsidiaries. That it's one thing when a GSIB says this is needed to protect the economy. It's a different thing for a regional bank to say that it needs to do this because it has this requirement that really exists nowhere else in the commercial sector. So I would expect to see there being more pushback and lengthier negotiations around this.
Yeah. So one last thing before I turn things over to Chris. There's also a capital deduction requirement. So very similar to the rule that's currently applicable to GSIBs, the proposal would require a deduction for covered firms' holdings of long-term debt and capital of other financial institutions. So this is like the cross-holdings requirement. And we talked about a similar notion when we talked a little bit about the Basel Endgame proposals, which are related. So maybe with that, I will turn things over to Chris to talk about how some banks may choose to react in light of these long-term debt requirements.
Thank you, Anna. Hello, as Matt mentioned, my name is Chris Chubb. I'm a lending partner in Mayor Brown's Chicago office. And what I've been asked to discuss is an alternative strategy, as Anna mentioned, that banks could use to comply with the new long-term debt requirements. So Anna talked through issuing new debt. We're going to talk about the other side of the equation. Since what the banks are being asked to do here is comply with either a total leverage test or stay below a percentage of total risk-weighted assets with this long-term debt. Another strategy they could take is to reduce the assets on the other side of the balance sheet. So in order to meet this requirement, the banks can sell loans, which are just assets of the bank. Now, as you all know, there's already a mature market for secondary sales of loans and large syndicated transactions. But this can be more than that. It can be beyond that. This could be sales in the context of bilateral bank loans or club-style syndications, really any kind of sale. In addition to full sales, it could also be accomplished by way of silent participations. Really anything that takes the asset off the balance sheet of the bank should work for this strategy. So really what we're talking about here, the same types of loans, the same types of sales that banks are doing already, participations, secondary sales, but they're just different in strategy. Now they may be doing it in order to comply with these rules. The key here, as we see it, to complying with the new requirements is to make sure that any loan transfer, asset transfer, or participation is treated as a true sale for accounting purposes, which moves the asset off the balance sheet of the bank. We can even imagine situations where banks will want to use the technology of the securitization world or other secured transaction to move these assets off the balance sheet. But again, the key analysis will be whether the transfer will be treated as a true sale for accounting purposes. Matt, anything you wanted to add there before I toss it back?
No, I think that's great. So we do have two ways to solve this. That obviously banks will have to issue some amount of long-term debt because it won't be possible to sell off all of a bank's loans. But we do expect to see increased loan sales and securitization because the markets, as Anna noted, are not the best right now. And so trying to fill that full 70 billion of gap of long-term debt with new issuances will be a challenge. And I think this shows the complexity of capital adequacy management that our great deal lawyers like Anna and Chris are wonderful at solving particular parts of the solution. And as a firm with our global platform, we really bring that holistic approach to capital management that allows banks to look for the most economically advantageous solution. So I'm not glad to see this proposal. I realize it will be quite expensive for some of our listeners, but I am glad that we're in a great position to help them out. I'd like to thank everyone who tuned in to this podcast. It was a good experience, and we hope you will continue to watch some of our podcasts around these capital issues. If you have any questions, please feel free to email us at gfm@mayorbrown.com. Thank you and have a good day.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.